All right, let's jump right into it. Today we are tackling one of the oldest, most debated questions in all of finance. Is gold a good investment? And we're going to find the answer by looking at this dramatic, clean break right in the middle of gold's modern history that most people completely miss. So, is gold a good investment? It sounds like such a simple question, doesn't it? But asking it just like that, without any context, is probably the single biggest mistake an investor can make. Because with gold, getting the context right, well, it's everything. You see, to truly get gold, you have to realize that it has lived two completely different lives. I mean, two totally separate existences. And if you confuse those two, if you mix them up, you are pretty much guaranteed to get the answer wrong every single time. And that brings us to the core idea for this entire explainer, a tale of two eras. Gold's history is not one long, smooth line. No, it's a story that's been split right down the middle into two very, very distinct periods. Okay, so on one hand, you have the fixed era, which ran from 1944 to 1971. The best way to think about this is that gold was literally an illegal cage. Its price was locked down, fixed by an international agreement called the Bretton Woods system. But then, on the other hand, you have the free float era, from 1971 all the way to today. This is when gold was finally unleashed, set free to have its price determined by the open market. So what was that price when it was stuck in the cage? Well, for 27 straight years, the price of one single troy ounce of gold was legally fixed at exactly $35. By law, it could not change, not by a penny. But here is the silent killer, the thing that was happening behind the scenes. While the price tag on gold didn't move an inch, the actual value of a dollar, well, that was a different story. Inflation was just quietly eating away at its purchasing power year after year. So by 1971, yeah, your gold was still worth $35, but those dollars bought 53% less than they did at the start. Holding gold was a guaranteed way to lose your real-world buying power. But then, everything changed. In 1971, that cage door was blown wide open, and the story of gold as a real modern investment, that's where it truly begins. And the dominoes fell fast. In August of '71, you get what's called the Nixon shock. The U.S. just unilaterally cut the dollar's link to gold. It was over. A few years later, U.S. citizens were actually allowed to legally own gold again, which they couldn't do for 41 years. And with inflation absolutely raging out of control around the world, gold just exploded. It rocketed up to a peak of $850 an ounce by 1980. Just let that sink in for a second. 24 times. In under a decade, the price of gold didn't just climb, it multiplied by 24. It was this massive, visceral reaction to the economic chaos of that era. A 24-fold increase. I mean, this was a completely different animal. This new, unleashed version of gold was reacting to fear and uncertainty in a way it simply never could when it was locked in that cage. So that incredible price explosion kicked off the modern era for gold, an era that's really been defined by these long, drawn-out cycles of boom and bust. And, more recently, by the arrival of a very, very powerful new force in the market. Because a fundamental rule of any market is that what goes straight up can also come straight down. After the absolute mania of the 1970s, gold entered an equally spectacular bust, losing a staggering 70% of its value. And it wasn't a quick drop either. From that 1980 peak, gold went into this brutal 20-year bear market. Once inflation was finally brought under control, investors just lost interest. The price fell by 70%. And this is a really crucial point. Gold is absolutely not a one-way street. But then another huge shift happened right around the 2008 financial crisis. As this report points out, the world's central banks, which for decades had been huge sellers of gold, completely flipped the script. They suddenly became the biggest buyers in the market. This created a powerful new source of demand that just wasn't there before. And this new dynamic has really shaped the 21st century. In the 2000s, you had this super cycle, mostly driven by new demand from emerging markets like China and India. Then came the big crises, the 2008 meltdown, the COVID pandemic. And what happened? Governments printed trillions of dollars, and investors poured into gold for safety. And now today, it's a mix of geopolitical risk and that relentless buying from central banks that continue to be huge drivers for the price. So after all these wild booms and busts, what have we actually learned? what is gold's true role for an investor today? It really helps to think about each asset in your portfolio as having a specific job. Stocks are there to build your wealth. Bonds are there for income and safety. But gold? Gold has a very different and very specific job description. It is a wealth preserver. And what do we really mean by wealth preservation? Well, think of it this way. Gold's job is not to make you rich. Its job is to act as insurance to help keep you rich, especially when the monetary system itself starts to look a little shaky. So, in a properly balanced portfolio, this is sort of how it fits in. As you can see, it's almost never the biggest piece of the pie, not even close. Instead, it's a smaller, strategic, defensive allocation that's designed to protect the value of all your other assets when a real crisis hits. And that really brings us to the final, most important thought. You don't hold gold for what it does day to day or even year to year. You hold it for what it does on the very worst days, when everything else seems to be failing. It's not about trying to time the market, it's about having insurance for those chaotic times that you simply can't predict.